I don't think that gold will go up as a consequence of a reaction to Trump. I think gold will go up because Trump will increase the deficit and increase the debt and make more apparent to everyone the fact that the purchasing power of their savings in U.S. dollars is declining, at the same time that Trump will continue to jawbone the Treasury to keep the interest rate artificially low. Jim Grant already calls the U.S. 10-year Treasury return-free risk. In an era of sustained low interest rates with rising deficits, my suspicion is that gold can't help but do well.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back to Liberty and Finance and Reluctant Preppers. We're delighted to have this well-recognized guest. Rick Rule, the CEO of Sprott Asset Management, is here with us again this Tuesday, February 25th, 2020. Rick, thanks for joining us again.
Dunagun, thank you for having me back. I enjoy your audience.
And our audience is very prolific in laying out questions that we would ask you when you visit here, because they appreciate your studied responses, and always eye-opening for people. We always get an education and appreciate that. We can't help but pick a few of those off the top that touch on some noteworthy topics that are happening currently. Right now, we've got some rather dramatic motions happening on the major equity markets, and some people are relating that to the coronavirus outbreak, or some people saying, nah, this was maybe the straw that broke the camel's back, but the camel's been loaded down for a long term in terms of the physical economy, what's been separating that between the asset markets. We have one question here from Metal Freaks 77 who says, does the coronavirus have the potential to pop the everything bubble? If so, what would that look like for real estate and other assets?
You know, if somebody gives a reasonably good salesman like me the ability to use words like could, should, would, I can make you believe anything. The truth is, I guess it is possible. My suspicion is that the liquidity that's in the system and the faith that remains in the system means that the blow dealt by the coronavirus, while it could be severe, is likely survivable. It's worth noting, and I'm certainly no immunologist or whatever you call somebody that studies pandemics. I bet it's a big word. Anyway, while I'm neither of those, it is worthy to note that 10,000 people are going to die of the flu in this country this year. And so you need to put the coronavirus in context. Going back to your lead-in question, my suspicion is that the market's reaction is a little bit of both. That is to say that people who didn't believe that the coronavirus would have any impact at all are seeing the effect, as an example, on supply chains from China, and also on the impact of Chinese demand for, among other things, raw materials, and are beginning to extrapolate that effect into other countries that are beginning to experience problems with the coronavirus. So I think the fears with regards to the coronavirus are real. I also believe that, at least by historic standards, conventional equity markets are pretty expensive on a price EBIT basis, on an enterprise value to EBIT basis, on a price book basis. Pick any basis that you want. And I understand, by the way, a sidebar comment, that equity prices could be higher than they normally would be because interest rates are so low that the cost of capital and the cap rate, in effect, has to change. But I still believe that the extraordinary level of equity prices that we have right now, and particularly the length of breadth in the market, that is the fact that the equity market strength is confined to so few issuers, means that the market was due for a correction. And I think coronavirus is both a real worry, but also a catalyst for the market reacting to valuations that were, by historical standards, I think, pretty stretched.
Fair enough. We have a related question to something you touched on there from LS, who's talking about the effects of this period to real real business activity. He says, I've been thinking about starting an online business with sourced products from China. I'm not as concerned about the coronavirus as I will be sourcing about a month from now. Is now a good or bad time to start a business? I'm concerned with the upcoming lack of liquidity, a stock market crash, or an economic downturn causing many not to spend.
Anytime that you have the capital and the time to invest in yourself and start a business is a great time. They say the best time to plant a tree was 30 years ago. The second best time is today. So to the extent that your questioner has access to both sufficient capital and sufficient time to do it, the time to do it is now. In addition, the time to show Chinese suppliers love is when no one else loves them. If they have 50 or 60 inbound calls a day, they're less likely to pay attention to you. But if nobody has called them for a week, it's pretty easy to stand out in a crowd where you're the only applicant. So assuming that your questioner answers questions number 1 and 2, do you have the time and do you have some money, correctly, this is a spectacular time.
It reminds me of a quote that I heard from you on a recent video on a natural resources topic where you were talking about you are either a contrarian or a victim, and that's, again, the contrarian mindset coming forth in your answer to that question. Very good.
Thank you.
This question, you mentioned in passing about the natural relationship between interest rates, or in other words, the cost of money versus the prices that affect. People have seen that in the real estate market. They've seen that everywhere else. But it goes beyond that because people have talked about that the banks, in many cases, central banks in some cases, are actually directly buying equities. The Bank of Japan evidently owns like more than half of the Nikkei index and so on. So this related to this question. D. Red says, I heard that a lot of money being printed goes into the stock market or real estate. Does it go somewhere from there, or do some entities just sit on it?
Well, of course, there's this thing called the wealth effect. When an individual, as an example, a reasonably wealthy individual, enjoys gains in his or her equity portfolio, or if they find their investment real estate or their house priced in the market at substantially higher than they thought it was worth, they suddenly feel more wealthy. They may borrow against the equity that they have in real estate, which in effect creates money. Or they might take out margin loans. You'll notice that margin debt is the highest that's ever been in U.S. equities markets. So in one sense, the inflated valuations that we're seeing in the equities markets and in the real estate markets do increase the velocity of money. They also, if you believe U.S. government officials, and with regards to this statistic, I'm inclined to believe them, which is unusual for me. Anyway, when people feel wealthier, they become more inclined to spend. That is to say that people who feel like they have wealth become more confident consumers. So I think the answer is yes. This sort of liquidity in the near term floats all ships. I'm concerned. I'm not trying to say it's a good thing, because usually what happens with excess artificial liquidity and artificially low interest rates is that businesses and consumers forward shift demand. That is to say, that demand that would have occurred a year from now or 2 years from now occurs now. And the consequence of that is that you build ever larger demand deficits. So I'm not trying to say that the outcome suggested by your questioner is a good thing, but I think it's probably an accurate observation on his part.
Right. Yeah, we've heard that described as either borrowing or stealing economic activity from the future into the present, which leaves a dead spot in the future that you're going to hit, and it gets deeper and deeper the more you do that.
Correct.
We have a question related here but this is about the industrial uses of silver and so on. Jim Markham asks, Rick, it seems as all production has been stopped in China due to the coronavirus, do you think silver will drop in price, and if this continues, and how much? If
it continues, I suspect that there might be a decline in the silver price. Industrial uses of silver are an important part of silver demand. And as an example, Chinese fabrication is the largest source of supply, as an example, for solar panels. And solar panels are an increasingly important part of silver demand. Similarly, water treatment and water purification is an important use of silver. And the Chinese are the biggest, the biggest markets for new water, water pollution abatement projects. So if the coronavirus continues to slow down industrial and economic activity in China, certainly industrial demand for silver will falter, and the silver price could falter too. It's important to note that the biggest of all uses intermittently for silver, of course, is investment demand. And if you see the gold demand continue and gold prices go higher, historically, silver has moved later than gold in terms of speculative or investment markets, but silver moves further and faster when it begins to move. If you hit a circumstance like the circumstance that we saw in the early part of the last decade, there's probably no industrial use shortfall that could offset investment demand. You will recall that in the last decade, 2001, 2002, 2003, we were coming off the demise of photographic printing, which was the biggest use of silver. And when that declining demand, ran into the demand from investments, the impact of photographic decline was very, very muted in the market.
Interesting. We have to preface this next question with a disclaimer that neither we nor Rick are here to give direct personal investment advice, but this is a principled question that we can address in the theoretical. The Red Pillar says, ask Rick if it's worth borrowing money at a fixed long-term rate, like 2.5% for the next 5 years, to buy more gold and silver in the hopes that they appreciate way more than that over that span of any interest accrued.
I would prefer that investors or consumers, particularly investors, never borrow to buy an asset that doesn't generate a yield. My preference is that if someone could buy, as an example, rental real estate where their return on capital employed was 6.5% or 7%, and they could get a long-term fixed mortgage at 4.5% or 4.75%, that they might consider that depending on the rest of their circumstance. But I personally don't like the idea that people borrow money to invest in assets that don't generate a yield. Money historically has been made investing on one of two deltas, one being the delta between the cost of capital and the return on capital employed. The other is a speculator on the delta between price and value. It's very difficult to establish a value for gold that isn't an ephemeral value. So it's very difficult to juxtapose the price against the value, except for as gold's function in insurance. And if something doesn't have a yield, obviously there's no delta between the cost of capital and the return on capital employed. So my preference is that people don't borrow to buy gold or silver.
All right. This next question talks about the gold market going forward and specifically how it might impact Sprott and those who are owners of any of your investment vehicles. Kyle Atkinson asks, I hope you can ask Rick, me being a shareholder of Sprott Inc., Sprott XF, how he believes the Sprott Inc. stock will perform in this upcoming gold bull market, and does he believe this bull market will last longer than previous ones?
I would suspect that when a gold bull market, particularly in the gold equities, reaches full swing, which I suspect it will, that the Sprott share price could do very well. Could do very well for two reasons. We've spent 10 years and millions and millions and millions of dollars positioning Sprott as a brand to represent, in at least North American investors' mind, the gold and gold equities market. 220,000 people, more or less, are now Sprott customers of the Sprott listed physical vehicles. So we think that the aura of Sprott, the identification that investors might have with Sprott in a gold bull market, will allow us to trade at higher metrics. At the same time, we would expect, as we're seeing, that our assets under management and our assets under administration will grow and grow much faster than our costs. If that happens, our earnings will increase, and simultaneously with that, our earnings multiple will increase too. And frankly, while I can never guarantee that, that's certainly the reason why I'm the largest shareholder of Sprott. I believe it to be true.
We have a question from Heike Frost talking about the U.S. dollar, and you as a credit analyst will probably be able to weigh in on something you think about a lot. Do you think it's possible that one day we wake up to the U.S. dollar index fall into half its value, or do you think the U.S. dollar gradually slides lower during the next 12 to 24 months?
I think the U.S. dollar gradually slides lower, but I think it takes a little longer than 12 to 24 months. The reason for that, I don't think, is the strength of the U.S. economy. As you point out, I am a credit analyst, and I'm afraid of the credit. I'm just less afraid of the U.S. dollar as a credit as I am its competitors. We've said on earlier interviews, Dunagun, you and I, that Doug Casey describes the U.S. dollar as, quote, the prettiest mare at the slaughterhouse. That might be a bit extreme, but the truth is that, as Franz Pick once said, there's a lot of ruin left in this country. We've done everything we possibly can to debase the dollar, negative real, if not nominal interest rates, exquisite amounts of debt, idiotic spending, politicians that are, at least from my point of view, an acquired taste.
Why don't you tell us how you really feel, Rick?
and the dollar continues to power higher as a consequence of the weakness of its competitors. Now, as a credit analyst, when I look at the U.S. dollar in isolation, when I look at $22 trillion in on-balance sheet liabilities and over $100 trillion in off-balance sheet liabilities, and when I look at the interest rate that I'm expected to enjoy on the U.S. 10-year Treasury, relative to the quality of the borrower, that is the U.S. government, and the rate of inflation, I'm astonished by the strength of the dollar. It's only when I look at our competitors that I understand the reason for that strength.
Interesting. So if 12 to 24 months doesn't sound like the right timeline, what are you thinking is a realistic timeline to see clear expression of weakness in the dollar?
I think you'll see it over 5 years. And I don't know how you will see it relative to other currencies. I think the way that you will see it is if you think about, let's say that you had $100,000 in savings now, and you had a rough sense of what you could do with the $100,000. I think 5 years from now, you'll be able to do demonstrably less as a consumer with that same $100,000. You and I have talked, and I won't repeat it, with my Motel 6 analogy. Other than to say when I was a young man, they called it Motel 6 because a room night there was $6. Now it's Motel 60. The pernicious effect of inflation takes place over time, and 5 years will be plenty of time to see it. If you compare it to, say, the yen or the euro or the yuan or the Canadian dollar, you might not see it at all because that's relative strength or relative weakness. But when you compare the purchasing power of your dollar now to the basket of goods and services that you propose to buy 5 years from now, my suspicion is that you'll see it in spades, and it won't be pleasant.
Yeah, it takes me back to my, I have a degree in physics, and we talk always about the difference between your frame of reference. Are you at a fixed or relative frame of reference? And if you're just falling along with all the rest of them, it's almost like being in free fall before anybody pulls their parachutes. It's like, okay, yeah, this one might look stronger than that one, but we're all falling.
That's precisely correct in my view.
This question traipses over into the political realm, and that's not our main point, but people do want to understand the macro environment within which these events are playing out in our lives. Raygor 4830 asks, do you think President Trump will be reelected, will reset the economy in his second term, and is that what will make gold go so high and how high do you think it might go? So there's 4 different questions, all huge ones, but do you want to take a crack at any of them?
Well, that's shot an hour. Where do I start? If you watch the Democratic presidential debates, the only thing that you can come away with is that the best possible campaigners for Trump are the Democratic candidates. I don't think, left to his own devices, that President Trump would have a prayer of being elected. But given who he's running against, it's looking increasingly likely that he will win. I know that'll anger the Trump supporters among your subscribers, but I think the only thing that'll keep him in power is the insanity of his opposition. I'm beginning to be of the view that he will be elected. Will he reset the economy? Yes. It will get much worse. Trump, remember, was a Democrat when it suited him. And Trump is not in favor of small government, and he's not in favor of constrained spending, particularly as it relates to entitlements, benefits to fat, old, poor, dumb white people. So I suspect that Trump will take the deficit from its current $1.2 trillion or $1.3 trillion to $2 trillion or $2.2 trillion. I hate having to say that. He's completely unwilling to tackle entitlements, and he has never seen a spending proposal which would benefit his constituents that he didn't like. So, yes, he will reset the economy. It will get worse. Maybe not as bad as, say, Sanders or Warren could do. But that's damning him by faint praise, is my suspicion. I don't think that gold will go up as a consequence of a reaction to Trump. I think gold will go up because Trump will increase the deficit and increase the debt and make more apparent to everyone the fact that the purchasing power of their savings in U.S. dollars is declining, at the same time that Trump will continue to jawbone the Treasury to keep the interest rate artificially low. Jim Grant already calls the U.S. 10-year Treasury return-free risk. In an era of sustained low interest rates with rising deficits, my suspicion is that gold can't help but do well.
And the last part of the question is, how well do you think gold can do?
I'm too old and smart to answer that question.
All right.
I have no idea, because you're asking me a question that revolves around market psychology, the impact of a narrative on a mob. As you and I have discussed, I don't even own a television set. My wife had to dress me for this interview. I honestly, I'm not skipping it. I just don't have the ability to answer those questions. I sort of deal in arithmetic, not narrative. But you do, as a credit analyst, you do look for, and you talk about this in other interviews we've seen, you talk about the difference between price and value. Hit for people what the difference is between price and value, and what would be principles or themes you would watch to observe for when you thought gold was richly valued. I can get you on that one. It's difficult to establish a value for gold because partly it's its value to you. Remember that gold's primary utility is as money, and so its value occurs relative to its competitors. Given that its purchasing power over time is relatively fixed, it can't be debased. What you look for in terms of value is relative value. Gold is priced today at $1,700 US, more or less. The value is ephemeral because you value it in a depreciating entity. I know that's a long-winded response, but it's the most honest response I have. In terms of circumstances to look for that are bullish, a negative real U.S. interest rate is very bullish, and a continued outlook for a negative real U.S. interest rate continues to be bullish. If, for some reason, the Fed was able to increase the interest rate, that is, if the U.S. 10-year Treasury went up from its current anemic 1.4 to some number like 3, I think you'd see the gold price clobbered. But I don't think you're going to see that in the next 2 or 3 years. Remember what happens given how much debt we owe if the interest rate goes up. If the government officials can possibly constrain the increase in interest rates, they're going to do it. In other words, inadvertently, the government is doing everything it can to subsidize the gold buyer. The most positive thing for the gold price, I think, is negative real interest rates on the US dollar. The thing that has really worked in the gold markets over 45 years from my point of view, the correlation that's really worked, is investors' faith in the ongoing purchasing power of their savings denominated in US dollars and expressed by US Treasury securities. With the current yield on the US 10-year Treasury at 1.4 or perhaps lower today, and the CPI stated rate of inflation at 1.7, the U.S. government is making you a promise that they absolutely will keep. They are promising you that if you give them money today, they will give you back less 10 years from now. A promise I believe they'll keep. And that's very good for the gold price. Not good for savers, but good for the gold price.
Rick, before we let you go, I wanted to ask you one more time if you're willing to re-up your offer to do some natural resource stock rankings for our viewers if they send them to you.
You know, Dunagun, we've extended that offer to several hundred of your subscribers, and I am delighted to have met them. So here it goes. For any of your listeners or subscribers, if you will email me your natural resource portfolios, importantly, with both the names and the symbols in text, not as an attachment that my security people won't allow me to open, I will rank the stocks in your portfolio 1 to 10, 1 being best, 10 being worst. I will comment on those companies where I think my comment has value. And I will also include a 45-year Barron's Gold Mining Index chart showing us where the gold equities are in a historical context, and also a 100-year commodity chart. I'm not a technical analyst, but these two charts give you the best visual picture I could possibly give you about where we are in terms of these markets. So to reiterate, rankings, RANKINGS is the email address. Your natural resource portfolio, names and symbols in text. I'll rank them, and I will include 2 charts and send them back by return email.
And folks, for the title of the email, if you could put Liberty and Finance, then Rick will know they came from us, and that'll help us to keep track of you as well, so we can make sure that we don't lose track of you and be able to stay in touch. Hey, I wanted to see if we could talk with you before we wrap here about an event where we're going to both be attending and where people can meet both of us, and that's the Sprott Natural Resource Symposium in Vancouver, July 21st through 24th of this summer, 2020. We're planning to be there, and what can people expect if they attend that conference? Why is it important for them to be there if they want to learn more about the natural resource sector?
Well, first of all, this conference has been in existence for almost 30 years. It's stood the test of time. We've had great speakers over the years, and this year is absolutely no change in terms of that. Daniela DiMartino Booth is an example. Nomi Prinz, James Rickards, Doug Casey, Steve Sugarrood. Great list of speakers. A great group of exhibitors, a wonderful place to learn who you speculate in. You know, Dunagun, at most investment conferences, the qualification to be an exhibitor, that is to have a booth, is to have a pulse and a check that cashes, usually in reverse order of importance. At our conference, a public company exhibitor that isn't owned in a Sprott performance fee generating account can't exhibit. That doesn't mean, unfortunately, that all the stocks are going to go up, but it does mean that we vetted them and we like them all well enough that we own them with our own money. We are confident enough in the value proposition of our conference that anybody who pays to attend the conference and does pay, if they don't think they've gotten their money's worth, if they give me a brief paragraph about why they thought they didn't get their money's worth and how I could improve it, I will refund 100% of their admission fee. So from a financial point of view, this has zero risk to your subscribers who become my attendees. I can make that kind of offer because I'm absolutely certain, based on the attendee satisfaction in past conferences, that my liability for this is zero. This is, if you care about precious metals and natural resource investing, I think the finest conference that you can attend.
Well, it'll be the first one that I'm able to attend. I'm delighted to be there. And folks, I would love to meet you too. So please do look at the link in this description of this video. Follow it. You'll find out more about the Sprott conference, and you'll be able to meet Rick and all those other speakers that he mentioned, and Dunagun Kaiser there, and look forward to seeing you. There's also a discount code in the description that you can use to get $50 off your attendance, so that'll help you as well. And look forward to meeting you all there in person at the Sprott Natural Resource Symposium, Vancouver, this summer, July 21st through 24th. Rick, any final thoughts about this tumultuous time that people find ourselves in before we let you go?
I think a couple things. Employ common sense. We're coming into a market that's going to have a lot of volatility attached to it, a lot of risk, a lot of opportunity. Maintain some liquidity, including some U.S. dollar liquidity. Despite the fact that the purchasing power of it is declining, the truth is that if we run into an air pocket, a liquidity crisis like we ran into in 2008, having liquidity will allow you to take advantage of that circumstance as opposed to being taken advantage of by that circumstance. And have some of your liquidity in gold and silver. It will be volatile. It will test you from time to time. But in past bull markets, the upside in precious metals coming off bottoms like the ones that we've been through can be extraordinary.
We've been speaking with Rick Rule, CEO of Sprott Asset Management, here again on Liberty and Finance and Reluctant Preppers. Rick, as always, thank you for joining us on behalf of myself and our viewers.
My pleasure. And I have to say how delighted I am to be hosting you in Vancouver. I absolutely guarantee that it will be worth your while.
Looking forward to it. Thank you.
Thank you.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your gold and silver and support this channel at goldsilver.com/?AFF=RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.